Great. All right, Alex, over
Great,
to
thanks,
you.
Josh. Hi, everyone. So, yeah, Alex, as Josh already mentioned, so I founded Easy Companies 11 years ago now, and we set out to become basically the easiest place to start a business online on your own, without needing all the red tape from the government. And we just made a really super simple way to kind of just jump online, fill out the information, and get your business off the ground. Now, if many of you have already set up a company, some of this is all going to seem quite basic. You've heard it before, but it's always good to have an understanding of the different types of structures that are out there and can be utilized for your business, especially when it comes to potentially putting a trust above your company and other advanced structures which we'll cover around IP holding companies. So let me just jump on screen share. How can everyone see that? Okay, great. So yeah, we found that starting a business in Australia was just a very complicated process. There's just so many different departments. It's not a centralized department, and there's all these different websites you have to jump through and try to find the information that you need. So we thought there has to be an easier way. So we set out to make the easiest place to start, run, and also manage your business. So from the compliance aspects and moving forward, you've got your business off the ground. How are you remembering that you need to renew it on an annual basis, keep all your websites active, domain names, and also make sure you pay your tax on time and lodge those kind of tax returns when they're due. So I think it's important to understand the differences in structures that are out there. So we at Easy Companies see four main types of structures or common trends. So the first one is being the sole trader. So this is what you usually see for hobbies or like side hustles or just people who aren't really taking it that seriously, but just want to kind of get underway. And it's really where income also is under kind of a 120K amount, which is the second tier of tax, because that's when you get into more company territory. But the real benefits of a sole trader is it's just low cost. It's literally just filling out an ABN application and you're done. You can also register for GST at the same time. And the other benefit is that you can use your personal bank account. So you don't need to have this separate bank account. So this is for really people who just see a low income that's going to come through and just want really simple tax. So at the end of the financial year, they'll just tell their accountant, this is how much I spent, this is how much I earn, and then you just pay tax on that. The problem with a sole trader is that you get unlimited liability. So if anything happens as you're operating under a sole trader, and insurance, for instance, doesn't cover it, or say you get sued by someone, you as a whole, as a person, is liable. That could include your house, any other assets on your name, car, money in the bank account. So there's unlimited liability. So say you get sued for $1 million, and your main asset is your house for $1 million. They could just take that whole thing away from you, and that's it. So that's the biggest risk of operating under a sole trader structure. And then you have also other challenges, which is like if you're going to seek investment, no investor is going to touch the sole trader structure. And also, as you're scaling up, it's very hard to hire employees under a sole trader. It gets quite complicated trying to pay them on your own. So as we move into a partnership structure, it's really just two sole traders getting together, joining together to create a business. So you've got many of the same pros and cons there, but it actually has a greater disadvantage there, which is that you have to do another tax return. So at the end of the financial year, you'll be lodging a partnership tax return, and then also your individual tax returns. And then the other challenge of a partnership is that if you restructure, so say you have a co-founder that you're launching with, you're going to be in a partnership with, in 2 years you decide you want to go separate ways, but bring on another partner, it's very difficult to restructure. You're basically creating a whole new business, which involves, setting up a new APN, contracts, bank account, all that kind of stuff. So the sole trader partnerships, they're good for, really low income where you just want to test things out, get your APN and get underway. But we don't see them in any serious businesses that are seeking investment or earning good income, you could say. So that's where you move on to a company structure. So basically, companies are separate legal entities, so it's not really tied to any one person. It lives on its own right. And this type of structure is perfect for scalable startups, or people that are seeking to raise capital, or businesses that are earning over that 120K a year bracket. The reason we say that is because then you can start, working around different tax strategies. If any questions pop up as we go along, just leave those in the chat, and we're happy to answer those. The main benefit of a company is because of that separate legal entity status, you get limited liability. So if something happens in your business and you get sued, of course the business is at risk and all the assets in the business, but you as a personal director, shareholder, etc., aren't liable. You're only liable up to the value of your shares, which is usually about $1 you'll take out in shares. So not a lot. It doesn't mean you're not liable for any, criminal activities or other things that go on in the business. There's still that relationship there as a director, but it's more just around getting sued and things like that. That's also another reason why banks generally don't touch companies within about 6 months of starting up, because there's just no risk to the director taking out a loan because they don't have that limited liability. Or the bank will say, we want to, personally guarantee it against your own name. There are numerous tax benefits because a company can decide how and when income is distributed. And then you've got that investment and growth potential there. One of the disadvantages, however, of setting up a company is just that ongoing cost. So if you're seeing a cost of around $1,200 a year to be expensive, then a company may not be for you, or you're just not taking it. You're just not seeing the investment that worthwhile. So that's something to keep in mind, that a company costs roughly around $1,200 a year to keep active at bare minimum. That's just your tax return and any ASIC fees. So then you also have your increased compliance. That's a disadvantage of a company. So any changes to your address, name, directors, anything have to be notified within 28 days. So if you don't notify ASIC that you moved address 2 months ago, there can be fees of up to like $360 each time that happens. So it can be quite expensive to run a company. And the other challenge is that it requires at least one director at all times to be resident within Australia. So say you and your business partner start a business together, but then you both want to move overseas, you'll have to hire a local director here in Australia to operate or to be the local resident, which costs around $5,000 a year or so. So there is that challenge of a company that there's just more compliance, but it is, the benefits usually outweigh those disadvantages by a long shot. And then we've got the final structure that we see most common, which is a company. So it has all the benefits and pros that are already discussed, but operating under a trust. So this is just adding an extra layer of tax and asset protection. So you get a lot more flexibility. So this is, we really see this in businesses that, are willing to invest a bit more upfront to get the right structure so that they can really play around with tax down the track. So if you saw an accountant in today's world and said, I want to start a business, I want to get investment, I doubt they would just let you set up a company on its own. They would be recommending a company with a trust because you just get so much more flexibility. So we will discuss that in a chart later on, so you can kind of see how trusts work and distributions take place. But their main benefit is that flexibility. So you can really pay anyone from a trust. So the money that you earn in a company, it all trickles down into equity, and that kind of gets saved. And then at the end of the financial year, you could say, well, I'm going to pay that to a trust, and then the trust is going to give that to my partner. It's going to give a portion to, my kid that's over 18 years old. So you can start to dilute the tax rates rather than you as one person just taking on the whole lump sum of the company's earnings. So this is obviously companies that are, quite profitable. They would have these challenges. If you're obviously burning all the money you're making, you're not going to have this challenge, but it is something to think of, down the track when you are earning profit. How can you distribute that? The challenge of the trust, obviously, is just that you have more compliance, more complexity, there's more moving pieces. It also requires that additional tax return for the trust. You're also going to have different accounts for a trust, so there's just more ongoing compliance there. So this is the kind of overview of the four business structures that I've talked about, as you can see, company and a trust are the most expensive, but it gives you the best taxation advantage. And whilst the sole trader partnerships are cheaper and have lower ongoing costs, they just have those challenges of tax. So, as a sole trader, if you were to earn $450,000 in 1 year, you're just going to have to pay tax on that whole lump sum. You don't have any choice where to put it, where to move it. Once you're under a company or a company trust umbrella, you can start putting it into different companies and, kind of just pausing it. So you're not taking that income all at once. You can just access it when you need it and pay tax on it when you need it. So that's the real advantage. When I'm talking, just there's a question in the chat there from Sam. He's just saying the 120K gross or net. I'm really talking gross. It's just an arbitrary figure we use. Different accountants are going to have different benchmarks of where they see that switch between a sole trader and company take place. The reason we say 120 is because that's the next bracket after that. So you start to move into 37% tax rates, which a company only pays about 30% tax. So you can kind of park it in companies and then pay that extra little bit later, rather than you as a sole trader just having to pay 37% straight away from the beginning. So that's where that comes into in terms of the difference between sole trader and partnership company. Sorry. Any questions that come up, just throw them in the chat as we're going along. And let's cover the company under a trust structure as I discussed previously. I'll show you in a chart. So this is just an example of a really basic trust company setup. So you've got the corporate trustees. That is a separate company that has to be set up. It'd be very rare these days to see people being an individual trustee. And that probably all sounds very complicated, but just think of it this way. You're setting up a separate company to kind of be the owner of the trust, or to hold shares on behalf of the trust. Then you're also going to be setting up a trust underneath that corporate trustee, and then that together, those two hold shares in your trading company. So traditionally, a really standard company would just be I, as an individual, Alex Whiteside, own shares in AgTech Pty Ltd, and that's it. All this is doing is adding another layer between me and that trading company, and it's just setting up that trust so that later, when dividends are getting paid from the company, so say at the end of the financial year, you've earned a significant amount of money, and you want to kind of move that around. You're going to send that to the trust, and then the trust is going to go, let's send money to Mary, John, and Jane. And they can gift, say John is the kind of main controller here or the main beneficiary. They can gift that back to John, but Jane and Mary are individually paying tax on those dividends. So that's where it really comes into benefit, because if John was just to take that full amount as a salary from AgTech Pty Ltd, he would be paying a significant amount more tax than if Jane and Mary and John kind of spread that out evenly between them, but they pass it back to John. So he's still getting the gross amount, or the net amount, sorry, but you're just diluting those tax rates. So that's really the benefit. There's obviously many other benefits around a trust and why that makes sense, and operating that structure. There's just a question here in the chat. So later on, comments on using a unit trust. Yeah, so basically, without diving into that too deep, because I don't want to give any advice, legal advice or financial advice. This is all generic information. But a unit trust is really a fixed distribution pattern. So rather than just at the end of the year, distributions getting decided, do I pay it to Jane, John, Mary, etc. A fixed trust just says it's going to be Jane and Mary every year. That's it. So that works well in a situation where you might have founders or co-founders working together and want to own shares in their trading company through a unit trust, but it gets spread out equally every year, 50-50 or 25-25 if you've got quarters. So yeah, it just depends on, to answer your question, James, trusts can be quite complicated for investors to look at because they're trying to work out who the beneficial holder is. of a trust. So it's not published like it is on a company register where you have AgTech Pty Ltd. You can look that up and go, who actually owns this business? And you can see straight away. With trust, it's hard to know who the beneficial holder is. And then with so you've got IP holding company as well. That's a bit more of an advanced structure, but it's something to consider moving down the track. And I can explain how this works. So you've still got the trust over there holding the shares in AgTech Pty Ltd. All you've added on here is another company called AgTech IP Holdings, which actually just holds the trademark licenses, and it gets assigned the intellectual property. So all the work that you're creating, all the code or websites or businesses and business logic that you're creating gets assigned to that IP holdings company. And AgTech Pty Ltd is still the trading company, so it's issuing invoices, paying bills, paying employees, etc. But in this example, if say AgTech Pty Ltd is to go insolvent, so it couldn't afford to pay its bills, and it's been deemed that this company can no longer trade, they could just set up a new trading company called AgTech Pty Ltd. And the brand and IP is still sitting there, so they can't claim, as part of that insolvency, they can't claim that trademark and that word AgTech, for instance, in this example, is being sold off to someone else. All that's being sold off in that insolvency is the trading company itself. So you just set up a new trading company, bring back AgTech Pty Ltd, and you can basically consider yourself to be trading again. It's not that straightforward, but it's just an extra layer that you would set up to protect yourself down the track, because operating companies aren't really that hard to really just set up again. It'd be painful, but it'd be a lot harder if you lost all your trademark, all your brand name. Like for instance, with Easy Companies, most of our value is actually in that brand and the code that we built. It's not in the operations of the company. So if our whole company was to fall insolvency and our trademark is held under that company, then we lose it all. Basically, we can't even use the brand name anymore, because that could potentially be sold off to someone buying that company at a fire sale. But in this case, if we still own the trademark, they can't use that because we own the trademark. So that's really how the IP holding structure works. There is more complexity there because you have, another company, plus you're going to have to create contracts through a lawyer to make sure that the IP is being assigned. So Justine's just asked the question in the chat, using multiple trusts. I'm not sure exactly what you mean by is reducing what particularly, Justine. If you want to clarify that, I can come back to that question. Or jump on, feel free to jump on. So yeah, it'd be good to go through the basic steps of starting a business. And if you haven't already, I would assume that many people have, but if you haven't, through Easy Companies, it's a pretty straightforward process. So all you're doing is choosing a company name. So you just go out there, you see if it's available. If you do it through our website, it will tell you, straight away, yes or no, this is available, cannot be used. But keep in mind to check your domain name as well. So many people start a company, later find that maybe their domain name is not available. I would say that they're both as important these days, because in the online world, you definitely want to have your domain name. Then you're just filling out an application form. It's 5 to 10 minutes. You have a few details, your tax number and DOB, etc. Submit the application, and literally within about 5 to 10 minutes, you will receive your company number and ABN via email. At that point, you just sign the documents that we would provide you via email. So it's all a pretty straightforward flow. Store them in a safe place. And you're basically ready to open a company bank account. So we've partnered with NAB to kind of make that process quite simple and straightforward. Should only take you about 5 to 10 minutes to do that online. If you do have a trust involved, just keep that in mind, that if you're setting up trusts, it's not that straightforward to set up bank accounts. Usually involves visiting a branch. So one or two director company where the sole trader, both directors are just owning shares in the company. Very simple to set up online. But the minute you start involving trusts and things like that, the banks want to see all the deeds and have you come into the branch. So just keep that in mind that, trusts do complicate the process there. And then once you've done all that, you're basically ready to begin trading. At this point, you would think about, setting up insurance and potentially engaging an accountant just to understand your ongoing tax obligations if you've registered with GST, and also doing your tax return. But that's like the minimum level of business. And then you would add on what each individual business needs, like setting up a website or, seeking out real estate. It really just depends on what type of business you're in. And then, I guess there's a question of like, why would you choose easy companies? So interesting stat, 1 in 20 companies are actually set up through our platform every day. So our volumes are very high. And from that, we receive 96% satisfaction from over 27,000 reviews that you can view on our website. So in the 11 years of being in business, we set up over 160,000 companies have come through our platform. So the main element there is trust and ease if you're coming through our platform. So I'd love to hear any questions you have about that process, whether it be the structures or just starting a business in general if you haven't already. Anthony just got a question around how external investors generally view splitting IP and the trading in two. Yeah, it's not a question I could really answer, to be honest, without giving advice. I would say that would be a great question for Sprint Law, which is coming up later in the series, because we don't give it as much interface as to like how investors see things. We're more just starting it, more of a DIY platform. But you could have an investor sit there and go, yes, I see that you're splitting out the holding company here. So that's really where the true value is, because the IP is getting put into that. So they could just set up another company that sits above both operations and the holdings company, which is the one that they're investing in, so that they get the best of, all those entities together. So you can get as complicated as you want. Really. It just depends on how the investor sees that. So it'd be rare that they would invest in both of them. They would probably just set up another company or a trust or something to sit above that. Sam's just sent through a question: when changing from a sole trader to a company. Yeah, so is it basically Sam's saying when changing from a company to a sole trader, is it basically the same process through our system? And can you use your personal bank accounts? It's pretty much the same process as setting up a company, because you've got to consider that setting up a company is already creating a new legal entity. So what you'd basically be doing is setting up the company, and then you'd consider any assets that you have that you hold personally, because you've been a sole trader, you would sell those to the company. If you feel you've got very complicated situations, definitely speak to an accountant to understand how to sell those assets or make sure that IP is assigned to the company. But most people see it as a pretty straightforward process. If you have an existing business name, you can also use that for your company name as well at the same time. So usually there would also be no penalties if you're restructuring from a capital gains perspective, because you're basically selling your business to the company, which creates a capital gains event. But the government have put in place measures to allow small businesses to restructure without having those penalties. There's obviously metrics, certain rules around that, what can and can't be done, so check with your accountant. As for the business bank accounts, you would be setting up new bank accounts. So a company would have its own bank accounts under its own name, and pretty much every contract you have and relationships you set up, you would have to redo all of those under the company ABN. You can't reuse your sole trader ABN for the company. So I hope that answers your question. And if there's anyone else, Justine has a hand up. Is that to join in?
I just wanted to ask a question.
Yeah, go for it.
So I'm very familiar with a corporate trustee and discretionary trust. Have a couple of
Yep.
those. Can you move your AgTech company as that's set up as an individual company?
Yeah, I'll
To
switch
see,
back.
obviously with startups, you're not sure how they're going. So if you want to move them into the umbrella under that corporate trustee, is that something your site can handle, or do you?
Yeah, a lot of those are like we help you set up the entities really. So these advanced structures are more designed for like accountants and lawyers, just because you want to make sure you're getting the right advice. We wouldn't want to DIY it. You can set up the entities through us, but that assigning or moving of the, say you're moving out the IP, you would have to engage a lawyer to help you do that, potentially an accountant as well to value that IP, if that makes sense.
Yeah.
So less of a DIY approach other than just getting the ACN.
Yep, cool. Thank you.
Yeah. Okay, no problem. So no other questions in the chat. If anyone else has a question, feel free. Otherwise, I think that's pretty much it, Josh.
Yeah, I think so. Thank you very much, Alex.